What if the single biggest factor determining whether crypto makes you rich or wrecks you has nothing to do with which coin you picked and everything to do with when you were born? Not your timing in the market, not your portfolio allocation, not whether you bought the dip or caught the top, your birth year. The decade that shaped how you think about money, trust institutions, and take risk. Because right now, 4 generations are all buying the same assets, calling themselves crypto investors, and operating from 4 completely different sets of assumptions. And most of them have no idea that the person next to them is playing an entirely different game. This is not about young versus old. This is not about who's smarter or more tech-savvy. This is about the fact that in crypto, more than any other asset class in history, the generation you belong to determines what you're actually buying, why you're buying it, and whether you're positioned to win or set up to lose at exactly the wrong moment. And when you understand the structure underneath all of this, you are going to look at your own portfolio in a completely different way. Let's start with the numbers, because the numbers are brutal in their honesty. 42% of Gen Z investors own crypto today. That is nearly 4 times the number who hold a traditional retirement account. Not a slight preference, 4 times. Among millennials, the figure sits at 36% ownership. Gen X comes in at 24%. Baby boomers, 8%. The older you are, the less likely you are to hold digital assets. On the surface, that looks like a story about technology comfort or risk tolerance, but there is a much deeper structure underneath those numbers, and when you see it clearly, everything about this market starts to make sense in a way it probably never has before. Let's introduce 4 people, same city, same income bracket, all crypto investors, all holding assets right now. Marcus is 61 years old. He is a baby boomer. He spent his career watching the stock market build generational wealth for the people who trusted it. He watched gold protect purchasing power through inflationary decades. He watched real estate make ordinary families rich over 30 years. Marcus did not buy crypto because he wants to get rich quick. He bought Bitcoin because in 2024, the SEC approved spot Bitcoin ETFs, finally giving him the regulated institutional gateway he needed to participate without feeling like he was logging into a casino. Marcus owns Bitcoin and only Bitcoin. He sees it as digital gold, a hedge against monetary mismanagement and currency devaluation. He does not know what a DeFi protocol is and does not care to learn. He cares about one thing: when the dollar weakens, does Bitcoin hold value? He is not speculating, he is preserving. Sandra is 47 years old. She is Gen X. She was in her 20s during the dot-com collapse. She watched peers lose everything chasing tech stocks that had no revenue and limitless promises. She survived the 2008 financial crisis and watched the institutions she was supposed to trust get bailed out while ordinary people lost their homes. Sandra came to crypto not as a true believer, but as a pragmatist. She entered through Bitcoin ETFs and Ethereum exposure after getting the thesis from a financial advisor. She holds Bitcoin and Ethereum, both regulated, both widely understood, both with institutional backing. She is cautiously optimistic, but she checks her portfolio every single day, and her finger is always close to the sell button. Sandra's psychology is defined by one experience. She's been burned before by assets that looked different from everything that came before. That is not weakness. That is her entire financial biography talking. Jordan is 34 years old. He is a millennial. He graduated into the worst job market since the Great Depression. He watched older generations tell him to save, invest in a 401k, work hard, and trust the system, and then watch that same system fail him at the exact moment he needed it most. Stagnant wages for a decade, student loan debt that traditional finance sold him as an investment that would pay off, a housing market that moved so far out of reach that home ownership feels like a fantasy. Jordan did not find crypto because he wanted an alternative investment. He found it because the existing system had already shown him it was not built for him. For Jordan, owning XRP and XLM and HBAR is not speculation. It's a philosophical rejection of the financial architecture that produced his circumstances. He holds these coins with a level of conviction that Marcus and Sandra cannot fully understand because they never had Jordan's relationship with institutional betrayal. And then there's Zoe. She's 22 years old. She is Gen Z. She's never known a world without a smartphone. She learned about investing on TikTok before she had a bank account. Her first crypto she bought not through a brokerage or a financial advisor, but through a social platform, probably after a creator she followed mentioned it between two other pieces of content. 44% of Gen Z investors say their crypto decisions are influenced by FOMO, fear of missing out. That's not a fringe tendency. That's nearly half of the two largest crypto-holding generations admitting that social dynamics are driving capital allocation. More than half of Gen Z who own crypto started learning about investing through social media before they ever had a job. That's the double-edged sword of a generation raised digitally. They got into the market earlier and with more confidence than any previous generation, but they also built their financial worldview inside an ecosystem that rewards engagement, amplifies hype, and has no incentive to show you what happens 5 years later when the narrative changes.
Gen Z's average credit score sits at 676, 39 points below the national average of 715, according to a 2025 FICO report. Among affluent young investors, those with between $100,000 and just under $1 million in assets, 48% hold crypto. That is nearly double the rate of their Gen X and Boomer counterparts in the same wealth bracket. Among Gen Z and Millennial millionaires specifically, 50% hold crypto, compared to just 33% of their parents' generation. The confidence is real, the wealth is growing, but 72% of millennials and Gen Z believe it is no longer possible to generate above-average returns solely from traditional stocks and bonds. That belief is driving them into higher-risk assets, and crypto is the primary vehicle. The question is whether that conviction is being matched by the financial literacy to manage the volatility that comes with it. Because here is the number Marcus and Sandra understand, and that Jordan and Zoe are sometimes allowed to forget. Bitcoin dropped 47% from its October 2024 peak of $124,000 to roughly $66,000 by early 2026. That is not ancient history. That happened recently, and it happened fast. A 50% drawdown on a crypto-heavy portfolio is not a hypothetical risk. It is a scheduled event that every generation in this market will face at least once. Marcus barely flinched. He has seen gold and equities do the same. His time horizon is 15 years of wealth preservation, and he has the psychological and financial foundation to hold through carnage. Sandra pulled back her allocation, not panicked, not sold everything, but recalibrated. Her Gen X reflex to protect against the downside kicked in before the damage compounded. Jordan held. He has conviction in the infrastructure thesis and enough experience with previous cycles to know that the thesis does not die with the price. He is uncomfortable, but steady. Zoe sold at the bottom, not because she was weak, because she has a 22-year-old's financial foundation, limited emergency fund, limited experience with real portfolio drawdowns, and a social feed that was screaming danger faster than any traditional financial media would have. She bought back in higher after the recovery, the way retail always does, the way the data has shown retail always does. This is not a character flaw, it is a structural outcome. It is what happens when the generation with the greatest cultural enthusiasm for an asset class also has the thinnest financial cushion to absorb the volatility that asset class routinely produces. So where does that leave you? The question is not whether you should be in crypto. If you are watching this video, you almost certainly already are. The question is whether your position in this market matches your generation's actual psychological wiring, financial runway, and time horizon, or whether you have accidentally adopted someone else's playbook. If you are holding Bitcoin the way Marcus holds it, as a long-term store of value with a 15-year horizon and no leverage, that is a coherent and defensible strategy, regardless of your age. If you are holding Bitcoin the way Zoe holds it, emotionally reactive, allocation driven by social momentum, no plan for a 50% drawdown, that is a problem, whether you are 22 or 45. And this is the thing that generational framing reveals that almost nothing else does. The most dangerous position in this market is not holding the wrong coin, it is holding the right coin with the wrong psychology. Because the coin can recover, psychology drives the decision to sell at the bottom and buy back at the top. That decision destroys returns permanently, and no bull market can undo it. Here is what the math actually demands from each generation. For baby boomers engaging with crypto now, the regulated entry point finally exists. Bitcoin ETFs are real, the institutional infrastructure is real, but the position size matters more for you than for anyone else because you do not have 2 decades to recover from a catastrophic drawdown. A 5 to 10% allocation as a digital gold hedge is defensible. A 30% allocation in a retirement account is not. The asset has changed, your time horizon has not. For Gen X, your instinct to stay close to the exit is not paranoia, it is pattern recognition from living through 2 once-in-a-generation financial collapses. But that same instinct will cause you to underallocate to an asset class that may represent one of the most significant structural demand stories of the next 20 years. The tension between your survival instinct and the math of the wealth transfer is real. Living inside that tension productively is the actual challenge. For millennials, you have the thesis right. The conviction that the existing financial system was not built for you is not a conspiracy theory, it is a documented lived experience. But conviction is not a risk management strategy. Knowing why you hold something is only half the work. Knowing how much volatility you can genuinely absorb without making an irreversible decision is the other half. And you need both halves to stay in the game long enough for the thesis to pay out. For Gen Z, you are the most important generation in this entire story. The adoption rates are real. The inheritance tailwind is real. The cultural fluency you carry into this market is genuinely an advantage over every generation that came before you. But 2 things can be true at the same time. You can be right about the direction of this technology and make decisions that prevent you from actually benefiting from being right. Financial literacy is not optional for you. It's the difference between being the generation that inherited the crypto wave and the generation that got wrecked by it twice. Because here is the final number you need to hold in your head. 1 billion people globally are currently unbanked. 61% of crypto users aged 18 to 34 in Latin America use digital assets for remittances because traditional banking is too expensive or inaccessible. Over 50% of Nigerians own or have used crypto. 74% of crypto holders in Nigeria are under 30 years old. This asset class is not just a wealth-building tool for tech-savvy young people in developed markets. It is financial infrastructure for populations that the existing system left behind. And the generation that built that usage from the ground up is yours. The money is coming. The institutional infrastructure is arriving. The regulatory clarity that was missing for a decade is being built right now. The $124 trillion wealth transfer that will reshape global capital markets is already in motion. The only question is whether you are holding crypto the way your generation needs to hold it, or whether you are holding it the way someone else's YouTube channel told you to. Those are 2 very different portfolios, and over the next 10 years, one of them is going to look like genius, and one of them is going to look like a lesson. If this hit different than what you normally watch, hit the like button. Not for an algorithm, because this kind of data-first breakdown takes real research to build, and the like is what tells the platform it deserves to reach more people who are making these decisions right now without the full picture. Subscribe if you want the math behind what's actually happening in this space, not price predictions dressed up as analysis, not hype masquerading as research. Real structure, real numbers, real consequences. Here's the comment question, and I want a genuine answer, not a price target. Which generation do you think is best positioned for crypto over the next 10 years? Gen Z with the adoption rate and cultural fluency? Millennials with the thesis conviction and wealth momentum? Gen X with the risk discipline? Or boomers with the capital? Make the argument. I will be reading every single one. And if you know someone who is holding crypto without ever having sat down and examined whether their strategy actually matches their life stage, send them this, not to change their mind, just to make sure they have the full picture before the next drawdown tests their conviction. The market doesn't care which generation you belong to, but the market will absolutely punish you for ignoring it.